The Enduring Wisdom of a Random Walk Down Wall Street. In finance, few books match the cult status of Burton Malkiel's A Random Walk Down Wall Street. Published in 1973, it introduced the efficient market hypothesis, or EMH. Decades later, its insights remain relevant, offering a timeless market framework. Join us to explore key lessons from this investment classic. Whether seasoned or new, understanding its principles can be transformative. We'll delve into market unpredictability, long-term thinking, and disciplined investing. Equip yourself with knowledge to navigate the investment landscape confidently. Let's dive into A Random Walk Down Wall Street and uncover its enduring wisdom. Technical analysis studies past price movements to predict future trends, captivating investors. However, its predictive power is often overstated. Charts offer historical insights, but forecasting future movements is debatable. Proponents point to patterns suggesting future direction. These patterns are subjective, leading to varying conclusions. Past trends may not repeat, influenced by changing variables. The book cautions against relying solely on chart patterns. Recognize its limitations in forecasting the unpredictable market. Adopt a holistic approach, incorporating fundamental analysis and market dynamics. Time, not timing, is key. A Random Walk Down Wall Street teaches us the power of staying invested. Predicting market peaks and troughs is a fool's errand, even for professionals. Trying to time the market often leads to missed opportunities and lower returns. Embrace market volatility and focus on long-term growth. Accept short-term fluctuations to avoid impulsive decisions. Ride out turbulence and benefit from compounding returns. Shift perspective to sustainable growth over decades. Patience and discipline are key. Focus on long-term growth to build lasting wealth. Embrace a long-term perspective and let compounding work its magic. Align with the random walk theory, focusing on time horizon and strategy. Investing in the stock market is like riding a roller coaster, with highs and lows. A Random Walk Down Wall Street says timing these peaks and dips is often futile. Staying invested during volatility is crucial to maximizing returns. Market downturns are a natural part of the economic cycle. Missing the market's best days can significantly impact long-term returns. Staying invested allows you to capture gains when the market rebounds. A long-term perspective helps ride out fluctuations and focus on the market's upward trajectory. Like a roller coaster, the market tends to recover from downturns. One of the most powerful yet often underestimated forces in investing is the time value of compounding. This concept, often referred to as the eighth wonder of the world, highlights the exponential growth potential of investments over long periods. A Random Walk Down Wall Street stresses the importance of harnessing this force by staying invested and allowing returns to compound over time. Compounding is like a snowball effect. As you reinvest earnings, those earnings generate their own earnings, and so on. The longer your money remains invested, the more significant the snowball effect becomes. This is why starting early, even with small amounts, can have a dramatic impact on your long-term financial well-being. A Random Walk Down Wall Street encourages investors to view time as their greatest ally in building wealth. By adopting a long-term perspective and allowing compounding to work its magic, even seemingly modest investments can grow significantly over time, leading to financial security and freedom. The key takeaway? Patience is truly a virtue in investing. By embracing a long-term mindset and consistently investing, you can harness the exponential growth potential of compounding and pave the way for a brighter financial future. Navigating the unpredictable swings of the stock market can be daunting, even for seasoned investors. A Random Walk Down Wall Street introduces a simple yet effective strategy for managing market volatility and potentially reducing risk dollar cost averaging. This disciplined approach involves investing a fixed amount of money at regular intervals, regardless of market fluctuations. By investing consistently, you buy more shares when prices are low and fewer shares when prices are high. This strategy can help to smooth out the average cost per share over time, potentially reducing the overall impact of market volatility on your portfolio. Dollar cost averaging aligns with the book's emphasis on removing emotion from investment decisions. By sticking to a predetermined schedule, you avoid making impulsive decisions based on short-term market movements, and instead adopt a more rational and disciplined approach to building wealth. Whether you're just starting out or have years of investing experience, dollar cost averaging offers a straightforward and effective way to navigate market uncertainty and potentially enhance your long-term returns. By embracing this disciplined approach, you can focus on what you can control, consistent investing, and let the power of time and compounding work in your favor. Shifting from speculation to long-term growth. A random walk down Wall Street encourages a shift from short-term trading to long-term growth. Embrace diversification, risk management, and align your strategy with your goals. Understand your financial goals and develop a tailored investment strategy. Diversification helps mitigate risk and build lasting financial well-being. Higher potential returns come with higher risks. Lower risk investments offer modest returns. Your position on this spectrum should align with your goals, time horizon, and risk tolerance. Understand this trade-off to make informed decisions. Manage risk in a way that aligns with your circumstances and aspirations. A balanced portfolio can maximize returns while managing risk within your comfort zone. Assess your risk tolerance before investing. Factors like age, financial situation, and goals influence your risk tolerance. Understand your comfort level with risk to make informed decisions. Build a portfolio that aligns with your comfort zone. Don't put all your eggs in one basket. Spread investments across different asset classes, industries, and regions. Diversification reduces risk by not relying on a single investment. Manage risk effectively by spreading investments. A balanced and resilient approach can enhance long-term returns. Your investment strategy should match your goals, risk tolerance, and time horizon. Ensure investments remain aligned with long-term objectives. Index funds track market indices, offering broad market exposure. They operate on a passive investment philosophy, mirroring market performance. This approach aligns with the efficient market hypothesis. A disciplined approach to investing can yield rewarding results. Passive investing embraces market waves rather than outmaneuvering them. Index funds replicate market performance, avoiding complex strategies. This approach reduces costs and risks, potentially yielding higher returns. Letting the market work for you can be an effective investment strategy. ETFs track market indices but trade like stocks, offering flexibility. They provide intraday trading and lower expense ratios. ETFs are cost-effective for broad market exposure or targeted investments. They offer a flexible way to participate in market growth. Index funds and ETFs have lower expense ratios, impacting long-term returns. Minimizing expenses allows your money to compound effectively. Every dollar saved on fees is a dollar earned. Index investing offers a straightforward, cost-effective approach to building wealth. The efficient market hypothesis asserts that stock prices reflect all available information. Index funds align with this principle, offering a compelling strategy. Trying to outsmart the market is often futile and costly. Index funds provide broad market exposure without complex strategies. They offer a reliable, cost-effective approach to long-term wealth building. A random walk down Wall Street delves into the fascinating realm of behavioral finance, exploring how our own psychological tendencies and cognitive biases can influence our investment decisions, often not in our favor. The book highlights that understanding these biases is crucial for making more rational and profitable investment choices. One of the key takeaways from behavioral finance is that we are not always rational actors in the market. Emotions like fear and greed can cloud our judgment, leading to impulsive decisions we later regret. We might buy high on a wave of euphoria or sell low in a panic, driven by short-term market noise rather than sound investment principles. A random walk down Wall Street encourages investors to recognize these emotional pitfalls and develop strategies to mitigate their impact. By understanding our own behavioral biases, we can make more objective decisions grounded in logic, research, and a long-term perspective, rather than being swayed by the heat of the moment. This awareness of our own psychological tendencies empowers us to become more disciplined investors, less prone to making costly mistakes driven by fear, greed, or herd mentality. By recognizing that we are all susceptible to these biases, we can take proactive steps to counteract them and make more rational choices aligned with our long-term financial goals. A random walk down Wall Street cautions against succumbing to the herd mentality. This tendency to follow the crowd, driven by FOMO, can result in buying high and selling low. It's easy to get swept up in the excitement and join the frenzy. However, the crowd is not always right, often leading to losses. Resisting the pull of the crowd requires independent thinking and discipline. Conduct your own research and stick to your long-term plans. Avoid impulsive decisions driven by the herd mentality. Achieve your financial objectives through a well-informed approach. A random walk down Wall Street acknowledges the powerful role that emotions play in our investment decisions, particularly fear and greed. These primal instincts, while natural human responses, can wreak havoc on our portfolios if left unchecked. The book emphasizes the importance of recognizing and managing these emotions to make sound investment choices. Fear, often amplified by market volatility and negative news cycles, can lead to panic selling, causing investors to liquidate positions at the worst possible time. Greed, on the other hand, can fuel irrational exuberance, driving investors to chase returns and buy into overvalued assets, only to experience losses when the bubble bursts. A random walk down Wall Street encourages investors to develop emotional discipline, resisting the urge to make impulsive decisions based on fear or greed. This involves sticking to a well-defined investment plan, focusing on the long-term horizon, and tuning out the short-term noise that can trigger emotional reactions. By understanding how fear and greed can influence our investment behavior, we can take steps to mitigate their impact. This involves developing a long-term perspective, diversifying our portfolios to withstand market fluctuations, and seeking guidance from financial professionals when needed. A random walk down Wall Street sheds light on another insidious behavioral bias that can hinder our investment success: anchoring bias. This cognitive trap leads us to fixate on a particular price point, often the price at which we purchased an asset, influencing our future investment decisions, even when those past prices are no longer relevant. For example, if we bought a stock at $50 per share, we might be reluctant to sell it even if it drops to $30, clinging to the hope that it will rebound to our initial purchase price. This anchoring to the $50 price point prevents us from objectively assessing the stock's current value and making rational decisions based on its future prospects. A random walk down Wall Street encourages investors to break free from the chains of anchoring bias by focusing on the present and the future, rather than dwelling on past prices. This involves evaluating investments based on their current fundamentals, growth potential, and risk profile, regardless of our initial purchase price. By recognizing and overcoming anchoring bias, we can liberate ourselves from emotional attachments to past prices and make more rational investment decisions based on a clear-eyed assessment of current market conditions and future potential. Successful investing is not just about picking stocks or timing the market. It's about a mindset of discipline, patience, and a long-term vision. This mindset helps navigate market ups and downs for lasting success. Discipline means sticking to your plan, even when emotions run high. Patience requires trusting the process and allowing investments to grow. A long-term vision focuses on ultimate financial goals, not daily fluctuations. Embrace discipline, patience, and a long-term vision to achieve financial success. Predicting short-term market movements is a fool's errand. A disciplined approach can lead to long-term financial well-being. Embrace the market's unpredictability, focus on factors within our control. Avoid chasing gains, align with the market's natural rhythms. Diversification, long-term investing, and low-cost index funds are key. Grounded in market efficiency, this philosophy helps us make rational decisions. Focus on strategy, risk tolerance, and time horizon for clarity and discipline. Despite being published decades ago, A Random Walk Down Wall Street remains strikingly relevant in today's rapidly evolving investment landscape. The book's core principles, rooted in market history, economic theory, and human psychology, transcend the ever-changing tides of financial innovation and technological advancement. While new investment vehicles and trading platforms emerge, the fundamental tenets of diversification, long-term investing, and cost-effectiveness remain as crucial as ever. The book's insights into behavioral finance, highlighting our susceptibility to emotional decision-making, serve as a timeless reminder of the importance of self-awareness and discipline in navigating the markets. The enduring relevance of A Random Walk Down Wall Street lies not in providing specific stock tips or market predictions, those are fleeting and unreliable, but in equipping investors with a timeless framework for understanding market behavior, managing risk, and making informed decisions aligned with their financial goals. In an age of information overload and constant market noise, the book's message of simplicity, patience, and a long-term perspective serves as a beacon, guiding investors towards a more rational, disciplined, and ultimately more rewarding approach to building wealth. Armed with the insights of A Random Walk Down Wall Street, we can approach the investment landscape with greater wisdom and confidence, equipped to navigate its complexities and capitalize on its opportunities. By embracing the principles of diversification, we create a portfolio resilient to market fluctuations. Through the power of long-term investing, we harness the magic of compounding, allowing our investments to grow exponentially over time. By understanding our risk tolerance and aligning our investments accordingly, we create a portfolio that aligns with our comfort zone and financial aspirations. A Random Walk Down Wall Street empowers us to become more discerning investors, questioning market hype, resisting emotional impulses, and making decisions based on logic, research, and a long-term perspective. It encourages us to view investing not as a get-rich-quick scheme, but as a journey of steady progress and informed decision-making. By internalizing the book's lessons, we transform from passive market participants to active architects of our financial futures, equipped with the knowledge and mindset to navigate the investment landscape with wisdom, confidence, and a higher probability of success. As we conclude our exploration of A Random Walk Down Wall Street, let its timeless lessons serve as a catalyst for action, igniting a spark of empowerment to take control of your financial future. The journey to financial well-being starts today, with a single step in the right direction. Embrace the principles of diversification, harness the power of long-term investing, and choose low-cost index funds and ETFs as your allies in building wealth. Educate yourself about market dynamics, understand your risk tolerance, and craft a personalized investment strategy that aligns with your financial goals. Remember, investing is not merely about numbers and charts. It's about aligning your financial resources with your life goals, creating a future where you have the freedom to pursue your passions, support your loved ones, and live a life of purpose and fulfillment. The journey may be long, and the markets may be unpredictable, but with knowledge as your compass and discipline as your guide, you can navigate the path to financial well-being with confidence and achieve the financial freedom you deserve. Your journey starts now.